slow and steady wins the race. That saying is perfect for the stock market. Buying good companies at reasonable prices and holding onto them for the long term is a proven winning investment strategy. Dividend investing is arguably the best way to make money on Wall Street. That's likely because dividend stocks are associated with profitable, well-managed, and financially stable companies. They've gone through periods of economic and market turmoil and survived. If you want to buy the best dividend stocks for income, then the following 7 companies deserve your attention. These high-income dividend stocks generally pay superior yields compared to the S&P 500, can generate significant wealth over time, and just may double your income by 2024. Bank of Nova Scotia. This year, Bank of Nova Scotia has already made plans to expand in British Columbia and Quebec, 2 regions with promising development prospects. The Bank of Nova Scotia's operations abroad are mostly concentrated in the Pacific Alliance trading region, which consists of Mexico, Peru, Chile, and Colombia. The shares are currently trading at about $66, as opposed to almost $80 at their peak last year. The Bank of Nova Scotia has a strong capital foundation to weather a future recession, and concerns about the likelihood of significant losses on the portfolio of Canadian housing are probably unfounded. Arcos Dorados. Arcos Dorados is the largest operator of McDonald's restaurants in Latin America. It's also the world's biggest independent franchisee of the fast food giant's restaurants. It operates more than 2,300 restaurants in 20 Latin American and Caribbean countries. It represents a golden opportunity for investors looking for dividend growth stocks to buy. By focusing on McDonald's 3D growth strategy, digital delivery and drive-through, Arcos Dorados generates superior returns. Yet the stock is cheap, with shares trading at just 14.8 times trailing earnings and 11.3 times next year's estimates. They also go for a fraction of sales and an even smaller percentage of the company's forecasted earnings growth rate. Over the next 5 years, Wall Street expects earnings to grow at a whopping 43% compounded annual growth rate. Arcos Dorados pays a modest annual dividend of $0.20 per share that yields 1.5% annually. After the stock's nearly 30% advance this year, that puts it in line with the S&P 500's yield. But with a payout ratio of just 22%, the distribution is plenty safe and has lots of room to grow. Brookfield Infrastructure Partners. There's good reason utilities have long been seen as the ultimate widow and orphan stocks. They provide ballast for a portfolio during troubled times and perform well when the storm passes. Brookfield Infrastructure Partners has risen steadily over the past 15 years despite financial and housing market turmoil, recession, and a global pandemic. Brookfield is one of the largest owners and operators of critical global infrastructure networks. It includes traditional utility operations, railroads, toll roads, ports, data centers, data transmission assets, and 2 semiconductor manufacturing foundries. Its diversified portfolio of critical assets provides investors with a margin of safety. It is willing to buy and sell assets in what it calls its buy, enhance, sell, repeat strategy. Yet shares are down 20% over the past year. That gives investors an excellent entry point into this unique utility play. The 38.25-cent quarterly dividend yields a lucrative 4.7% annually. The company targets annual dividend growth of 5% to 9%. Clearway Energy, clean energy developer and operator. Clearway Energy is a renewable energy stock the market loves to hate. As interest rates rise, Clearway's stock falls. Shares are down 21% this year and 34% over the past 12 months. Yet, like Brookfield, it has a long runway for future growth and is among the best dividend stocks for income. Clearway has great insight into how to expand cash flows and grow its distribution. In May, the company raised its payout for the 12th consecutive quarter to 38 cents. The clean energy company expects to grow its dividend between 5% and 8% annually. Clearway's parent company, Clearway Energy Group, boasts an extensive backlog of renewable energy projects under development. Global energy giant Total Energies also acquired a 50% stake in the parent, potentially providing expansion opportunities. Enterprise Products Partners, midstream energy stock. Enterprise Products Partners is one of the largest publicly traded partnerships in the U.S. It takes its role as an energy industry middleman seriously. Enterprise Products has over 50,000 miles of pipelines, 14 billion cubic feet of natural gas storage, and over 260 million barrels of storage capacity for natural gas liquids, crude oil, refined products, and petrochemicals. It locks customers into long-term, fixed-fee, or take-or-pay contracts. That means EPD gets paid regardless of whether customers accept delivery of its product or not. The company's $2 annual dividend is also lucrative, as shares currently yield 7.5%. Despite the high yield, the dividend is safe. A distribution coverage ratio should not fall below 1 and ideally should be much higher. Enterprise Products Partners ratio is 1.6 times. There are complex tax issues that need to be considered when investing in Master Limited Partnerships, MLPs, but EPD is one investors should look closely at. AT&T Telecom, giant AT&T is a steal. The stock is trading at levels not seen in almost 3 decades, and the market is almost valuing the stock as if the company is going out of business. Shares trade for just 5.7 times next year's earnings estimates and less than 1x revenue and book value. That is a bargain basement valuation. AT&T says the fear-mongering is overwrought. With the telecom stock down 22.5% year-to-date, the annual dividend yield is 7.8%. The rollout of 5G networks is a major long-term growth catalyst. This could be a unique opportunity to buy AT&T stock at prices you may never see again in your lifetime. Realty Income, Real Estate Investment Trust. Realty Income is another battered dividend growth stock waiting to break out. The stock has lost 19% over the past year as concerns over the commercial real estate market grew. While the worries shouldn't be dismissed out of hand, they do seem a tad overblown. Realty Income primarily owns single-tenant properties. The tenants pay the taxes, insurance, and maintenance in addition to the rent in what is called a triple net lease. It relieves the landlord of the burden. The businesses Realty Income is leasing to are also top-notch. The REIT counts 7 to 11, Dollar General and Walgreens among its top tenants. When other REITs were cutting their distributions to unit holders during the pandemic, Realty Income was raising its payout. The REIT has raised its dividend 121 times since 1994 and made 637 consecutive monthly payments. It also offers the benefit of paying its dividend monthly. With an annualized payout of $3.07 per share, O stock currently yields 5.2%. York Water. York Water is a utility every investor should consider, as its services are essential. The company provides clean water and wastewater services to 54 municipalities in south-central Pennsylvania. York Water is an under-the-radar dividend growth powerhouse. It hasn't missed a single dividend payment in more than 200 years. York Water yields 2% annually. That's barely above the S&P 500, which might make it hard to double your income by the end of next year. However, York Water's consistency, reliability, and safety are head and shoulders above any other stock on the market. That makes it one of the top dividend stocks for 2024. Thank you for watching our video on dividend stocks with the highest growth potential for 2024. We hope you gained valuable insights into these promising investment opportunities. Remember to conduct your due diligence and consider your financial objectives before making any decisions. If you enjoyed this content, don't forget to like, share, and subscribe for more financial updates and investment tips. Happy investing!